All right, guys, just got home and I wanted to post a bit of a rant about these rate cuts. So I've been seeing so much noise out there. Everyone's freaking out. Some are calling it the biggest opportunity in years, and others are saying that house prices could surge and make things even more unaffordable. People are saying, what should I buy right now? But honestly, I don't think that any of that is what really matters. I've been an investor for over 20 years, and in that time I built a $30 million property portfolio and done millions more in developments. So if you're an investor who actually plays the long game, focused on long-term growth, then this stuff shouldn't rattle you. And if you stick to the end of this video, you will know exactly why. Let's start things off by talking about how things work. As you may or may not know, there's a thing called monetary policy, which basically underpins our economy. This is where the central bank, the RBA, influences the supply of money in order to achieve certain economic objectives, such as controlling inflation. In Australia, we have the RBA of Australia or the RBA, who play this role for us, and seemingly everybody has an opinion around their performance and whether it's good enough, what they're doing, or whether it's not good enough. Now, in fairness to the RBA, the problem with monetary policy is not straightforward at all. The data that they're using has a bit of a lag effect, so often they're trying to catch up on what has happened in the past since the last read. And more concerningly, it really depends on what's happening with the government, specifically with government spending, as to what's going to happen in the economy. So this becomes a real challenge for the RBA if they have a government who, on the one hand, say that they want it to keep inflation under control, and then on the other hand, they're rampantly spending money and doing different things which are inflationary to the economy. Then if you rewind the clock and look at the rate tightening cycle back in May 2022, we had our last rate hike in November 2023. So throughout 2024, commentators were predicting rate cuts, and however, none of these actually came to market as the data kept showing that we had too much inflation to warrant rate cuts. And it wasn't until February 2025 that we finally saw the first cut. Again, there are very many reasons for the delay to these rate cuts, but one of the major contributors was the disconnect between the government and the RBA. And typically you'll find this where some governments have a better economic understanding than others and understand what levers they can control, the implications of them, and without getting into any of the politics here, different parties have a different approach. So now if you think back on the principles of property growth, you'll recognize that a little bit of inflation is an investor's friend, particularly because when the supply of money increases, so does the value of assets. So if you think about it like this, the more there is supply of currency, the less that currency is worth. One of the big problems that comes with inflation though, is that the RBA will put up rates in order to get it under control, which means higher costs for investors and lower net returns. So a little bit of inflation is good, but not too much. So with the long-awaited rate cut that came through in February 2025, on the face of things, this is not a huge deal. I'd say the reaction to this over the time has mostly been sort of overhyped because the rate cut's been so overdue, and the media hype around inflation and interest rates been going for seemingly years. The reality though is that if you're an investor with an 800K loan, 0.25 reduction equals only $38 per week difference. So while every dollar is important, that's hardly going to break the bank or hardly going to get you to financial freedom by saving $38 a week. What it does unlock, however, are two major pieces. So one, there is a slight improvement to serviceability, which means that people can borrow more, and this can help drive values up. There's often a vast improvement, however, in sentiment when rates are cut, and this is what can stimulate growth, which is much of a bigger deal. So number one, we can quantify the effect of a rate cut. So if we've got one of our investor clients who have $1.95 million of existing lending, prior to the rate cut, they could only borrow an extra $260K. With the rate cut, they can now borrow $300K. So overall, borrowing capacity has increased 1.8% for them in totality, but it's about 15% more that they can borrow now in terms of real dollars. And number two, with sentiment, it can be very hard to quantify that. The overall capacity increases are a bit of a hint of the potential growth, But usually people don't borrow 100% of their borrowing capacity, particularly if it's an owner-occupier. So it isn't that easy to draw a correlation between sentiment and market improvement. Once people see markets starting to rise and grow, often that is the trigger for them to start moving and take action. So it becomes a bit of a self-fulfilling prophecy. People seem to move as a group. So it's much harder to buy something in a hot market where there are multiple people and a lot of competition buying together than it is in a depressed market where you can essentially negotiate harder if you're the only serious buyer. So in the current environment, where we're in the next stage of the credit cycle and rates are coming down, there are a few smart things to do. Make sure you review your existing lending. It's often a time where lender appetite can shift around, so make sure what you have got is actually set up correctly at competitive rates and take the time to restructure if you need to. Reassess your borrowing capacity. So if you're looking to buy, then make sure you check with your broker on what the rate cuts have unlocked for you. Potentially that rate cut could be the difference between what you needed to make the move, especially if that's combined with some restructuring of your facilities. And if you're looking to buy, but sitting on the sidelines, make a move sooner than later. Once things move in the market, they move quickly. Just like the data the RBA is using to make their decisions, if you're waiting for validation of growth in the area that you're looking to invest, then often it is too late. By the time it shows up in the data, things have already moved. And instead of being able to negotiate one-on-one with the vendor, with the property that you're now looking to purchase, you now have to compete with other buyers, and that will mean you can't negotiate as good a deal. So to sum up everything, my thoughts with the rate cuts. Yes, they're finally here, which is great, but hopefully this is just the start of a longer cycle. That said, it's not going to happen overnight. So you need to stay focused, you need to stick to your strategy, stick to your long-term plan. If opportunities come up and you're in a position to act, then capitalize. And if not, then just stay ready. And as always, if you're planning to invest and you want someone experienced to help you structure finance in the right way, then there is a link in the description. Brokers get paid by the bank, so there's no cost to you. And if you're not quite ready yet, then no stress. I'll be dropping a new video every week. So keep learning, stay sharp, and I will see you in the next one.